So the first thing I'd say is, look, I said this at the start, but it is very important to understand that nothing we've talked about today is financial advice. If you are interested in anything we've talked about, I do encourage you to always do your own research and speak to an advisor if you have one. And look, I might as well kick off. What is unlisted property? Well, very simply, unlisted, not traded on a stock exchange. Because it's not traded on a stock exchange, what sets the unit prices? Well, the unit prices are simply driven by independent valuations. That means on a 6-monthly basis, we will go to the market, bring in high quality external valuers, and they'll value every asset in our fund, and that sets the unit price. Unlike the listed market where it moves up and down based on what's happening in the equities world. We have monthly or quarterly distributions. Look, that's extremely important in the current low yield environment. We know from speaking to a lot of investors, a lot of these functions, many people invest with us because they need the income, they need that regularity, and depending on the fund which we're talking about, we either do monthly or quarterly is the furthest frequency have. But importantly, what isn't unlisted property? It doesn't mean you're getting a lower quality asset. It means you're still focused on that institutional space, the highest quality assets, regardless of the equity source. And interestingly, unlisted property brings a number of benefits overall to an investor's portfolio. Without getting into the actual numbers, unlisted direct property has a much lower correlation to other key investment classes such as bonds and equities, and has lower volatility than listed property and the markets generally. So what do we do at Charter Hall Direct? Well, our value proposition is very simple. We want to provide regular and stable growing income streams and the potential for capital growth. You've heard from our earlier speakers, at Charter Hall, we know what we do well and we like to keep things simple. That's long-term leases, high occupancy rates, and we focus on the tenant covenant. So who's paying the rent on those leases? And I'll give you some examples, and I'm fortunate I've got a few videos so you don't need to listen to me for the whole time as well. We've got over 13,700 investors. That's unique investors across the book. If you were to look at all the investors that have multiple investments with us, the number's closer to 20,000 separate accounts. And look, we do get all our products externally researched, and we've won numerous industry awards, which the team's very proud of. Part of the reason for that is they benchmark us against other products in the market and what we've been able to deliver and achieve for our investor base. So performance, and it comes with that old caveat, past performance isn't a reliable indicator, but it is important to understand if this is a sector you're considering, what the manager has done in this space over a long period of time. So these returns you can see here are up over the last 18 years. So I've been here close to 10 years, so prior to my time. All the funds you can see there, the light grey is the benchmark. The dark grey is simply funds that we've opened, raised equity for, and returned money to and shut the funds. The middle section are funds that are no longer open to new investment, but we're still managing the portfolio. And the ones there in the dark blue are the funds that are currently open for investment. Look, it's important to point out where we didn't get it right. I don't want to sit up here and say everything always goes exactly to plan. There's probably 2 syndicates in that grey section that were based in Perth where the returns weren't as high as we would have liked. They still generated a total return of 7% at least. And it's important to understand what happened in that market during the time. So since those products were launched, the rents in the office market in Perth fell 50%. So just think about that. The rents fell 50%. And yet we're still able to generate that strong return. The reason is because the group's strategy of long-term leases really insulated those assets from that downturn. The long leases mean you're never forced to sell assets at points in the cycle where you don't want to sell them. It means you're never forced to negotiate with tenants around vacancies and when rents have come off. It means we just sat tight, we waited for the market to turn, and as things have picked up, we then moved on and we sold the asset once the market had turned. But as you can see here, by and large, we've had a fantastic result, beating benchmarks on average around 3% over a very long period of time. And this chart is probably my favourite chart of anything I'm going to talk about. Not because it tells you anything absolutely amazing, but because the message is so simple. This is office unlisted property. And what you can see here is the blue bar. The blue bar is the income return each year for a 20-year period. So what you can see here is the grey is the capital appreciation, and you can see there the GFC, the asset class did come off, as did everything else. The black line being the total return, the summation of the income and the capital. But what you can see there, and I hope one thing you take away from everything I've spoken about here today, is the regularity and consistency of the income return. And for many investors, that importance has only increased over time when you're looking at term deposits, cash, which do have different risk profiles, but it's very difficult to live off those in the current environment. And so now I'm just going to take a little break. I'm quite fortunate in that I'm not talking about a bond or a derivative or something as abstract as that. We're talking about real property. So this is a short 3-minute video on Western Sydney University's campus out at Parramatta. We secured it working with our partners on a 15-year lease, fantastic tenant covenant, and it means because it's a new property, the capital expenditure or CapEx is extremely low, meaning as you just heard from Nick, low CapEx is great and means more money that gets passed through to our investors. So you will hear a bit of a voiceover from the Premier here, and it's good to see that the government is very focused on Parramatta. For those that aren't aware, and it's very easy to miss this if you're living in the eastern suburbs, North Shore, even where we are today, Martin Place, but Parramatta is the geographic centre, population centre of Sydney. If you drew a circle around Parramatta, you'll find that's the middle. And what you're seeing is more and more tenants are going out there because not only are the rents cheaper, around half of what they are in the CBD, but it's closer to their staff and it's where their people want to work.
We have here a world-class facility, which if I had my time again would be my first choice of where to study. We will see thousands of students come through these wonderful learning environments and provide our future leadership of our state and our nation.
One Parramatta Square is one of Western Sydney University's most important strategic initiatives. It's the most important project that we've undertaken in the last decade. It's a step for the university to move into the heart of Sydney by placing a vertical campus right in the heart of Parramatta.
We, some years ago, decided to take a strategic approach to really understanding the education sector. It's been a wonderful journey for our team to understand what really drives a university, particularly one like WSU that's trying to create vertical campuses and something that's going to connect their students much more to corporate life.
This is the most technologically advanced building in an Australian university, and I think it would stand up internationally. And we have infused technology right through this building.
The technology in this building is really great because it allows the students to have a really collaborative environment in classrooms, especially the screen sharing option that we have.
With technology all around, you have lecturers facilitating learning in a flipped classroom, and that's an innovation that we're very, very pleased to be bringing to Parramatta ahead of many other universities in Australia.
To have teaching spaces and hubs where lecturers and students can interact, where you can work as teams, it's a tremendous building. And we know already the feedback we're getting both from the lecturers but also from the students is really positive.
What I really like about this campus is the collaborative spaces that it provides. So it gives us the opportunity to book our own rooms to work on assignments with our group members, and also it has a really quiet environment that no other campus can provide with all its study booths.
Every level has a space or spaces for you to study, whether that be by yourself or with a group of people. It really motivates me to want to study and want to be at uni as well.
This is a great partnership with Charter Hall, a wonderful opportunity for us to be the tenant in this building.
It's been fantastic for us to deliver it on time, on budget, and to create a world-class facility. It's also a showcase. We've started speaking to a whole range of other education organisations, and I think we will see this as being the first of a number of investments Charter Hall Group make in the education sector.
What I especially love is that this will be the heartbeat of a precinct where we will see businesses come in, where we will see integrated facilities, which means we're not just creating a learning environment here, that entire new vibrant community. I feel extremely inspired, and may this building inspire thousands of others to reach their full potential into the future.
Slide and video didn't actually show, which I think is another key advantage of what Charter Hall brings. And remember, the business that myself and the team look after delivers that institutional quality property to retail investors, self-managed super funds and high net wealth investors. But in this case, we actually teamed up with our large wholesale office fund. So it meant the retail investors are investing in exactly the same assets, but you didn't need a $10 or $20 million check, which you need to access that wholesale fund. So it's about providing that highest quality institutional grade property to our investors. And to that end, it's worthwhile just running through 3 examples of some of our most recent transactions and how we put together deals for the portfolios that we manage. So the first asset there is Mary Street up in Brisbane. It's a large asset, as you can see, over $250 million. But what did we like about it? Well, the prior owner spent over $40 million fully upgrading that, meaning, again, the capital expenditure requirement's low. And look who the tenant is. Not only does it have a 10-year lease term, but it's the Queensland Government. We talked about the strength of the income covenant being critical, and it is absolutely essential because a 10-year lease is only as good as the person or entity who's paying that rent. And someone said to me the other day, well, Stephen, what happens if the government stops paying the rent? And I said, well, who cares, to be honest. The returns of this fund will be the last thing you're worrying about if the government weren't paying the rent. But it's such a ridiculous question to focus on that. We're one of the few AAA-rated countries in the world. The middle investment is the Main Freight industrial asset, which we recently developed. When I say developed, it's important to realise we didn't take on that development and construction risk. We had a binding long-term lease in place before we signed a single thing acquiring that property. So for industrial property, you've all heard about e-commerce, you've all heard about some of the challenges that your David Jones and Myers have. You need to think about flipping it around. The challenges for Myer and DJ's, they're a real strength for the industrial property market. So every time someone clicks on a keypad or flicks on an iPhone and orders something, a whole series of events happen, and they're typically triggered at industrial and distribution facilities. And again, this tenant, Main Freight, a $4 billion New Zealand market cap, a brand new facility close to the M7, M5, and that infrastructure linkage critical to the industrial assets. And finally, the asset, Shelley Street, again, we partnered up with our wholesale fund. So the value of that asset there, $260 million, is our 50% interest. So not only does it mean we get the highest quality, it means we get access to properties that would otherwise be too large, too much tenant concentration, too much geographic concentration, even for the $2 billion fund, the direct office fund which purchased it. So by being able to partner up with our wholesale vehicles, it means we get a much better portfolio construction and a better result for our investors. And so I might just use the direct office fund as a little bit of an example. It is our flagship fund, over $2 billion. I think it was Nick said before, we like things pretty boring and simple. Occupancy rate, 99%. Long-term leases, 8.6 years. Quarterly distributions, and the returns have been extremely strong over a long period of time. It is important to realise the returns, you shouldn't expect that going forward. In fact, I never tell people what to expect. All I can say is that at Charter Hall we take as many of the known risks out of portfolios as we can, and that comes from long-term leases, high occupancy, the covenant strength, gearing. Charter Hall, we typically have a gearing range across the suite of funds somewhere between 20 and 45%. We could increase the distribution rates on every one of the funds we manage simply by putting more debt into the vehicle. But we don't do that because at Charter Hall we're very focused on the risk-adjusted returns. So that is the return that's delivered from a given amount of risk that you put in. And gearing can amplify the returns, but it does amplify the risk. So if you are looking at this investment class, whether it's listed, unlisted, I always encourage people to look at the gearing that the manager has and for you to decide whether you think that's a prudent level. The weighting of this fund, 92% Eastern Seaboard, not an accident. 2/3 are Sydney, Melbourne, the two largest office markets, and we've recently pivoted the portfolio weighting to the Brisbane market, where we believe there's simply better value to be had. That asset, which we just talked about, Mary Street up in Queensland, 10-year lease to the government, 6% capitalisation rate. I can tell you if that was in Sydney or Melbourne, that capitalisation rate for a government tenant of that term would be below 5%. So you need to make sure you curate the portfolio to deliver that regular and growing income stream. And the tenants, as I said already, 29% of the portfolio is government, so that's federal or state. But even outside of these tenant covenants, you need to look at groups like Suncorp, Coles, Westpac. We heard from Bill Evans. They're a key tenant. We have one of their properties, and we actually own that asset, again, 50-50 joint venture with the Long WALE REIT. So again, it's about spreading the portfolio risk amongst the various vehicles. So these are our largest tenants, and again, it's not an accident that we end up with these tenants in the portfolio. The group works extremely hard through the asset management and property management teams, which we have located throughout the whole country, to develop these portfolios in the way that we do. And something that is a little bit unusual about Australian commercial property, so that's regardless of the sector and sets it apart, is that we benefit typically from fixed rental increases that mean the rent increases year on year. So for a fund like the Direct Office Fund, it's 3.6%. But just for maths, if we assume it's 3.5%, it means if I'm a tenant in this portfolio, on average, I pay $100 year one. Year two, I'm paying $103.50. Year three, $107.12, $110.82, and so on. It's got built-in compounding, which simply means that the distribution rate's able to increase over time for the benefit of the investors. Our PFA fund, look, it's slightly smaller. It focuses more on CBD and emerging markets. It has monthly distributions. We actually took this fund over from another manager in excess of 5 years ago. It took us a long time to bring that portfolio up to a position where we wanted to reopen it to new equity. We reduced the gearing, we simplified the strategy, and we focused on all the things we've talked about today. The industrial fund. Our marketing is good at Charter Hall, but to be honest, it's not something we've particularly focused on, and you can see that in the fact it's called the Charter Hall Direct Industrial Fund number 4. No guesses that 3 more came before it, but the reason why we've continued to do this, it's a series investors know well. It's a sector that we were first to make this option available to high net wealth and retail investors back in 2010. We think the sector thematically has a lot of tailwinds going for it, and being able to provide a pure play unlisted exposure to this particular sector, we think is a real opportunity that isn't always made available to retail investors. So with industrial assets, you typically get a longer term lease, so a little over 10 years here, 100% occupancy. You can see it's a little bit boring, isn't it? We're talking about the same thing. But it is good to be simple on the strategy. It means it's clear to the team and it's clear to the investors how we execute it. And I'll just show you a video of the main freight facility, which is owned by Diff 4. Many people, when you hear industrial or logistics, think dirty warehousing, plastics, steel, manufacturing. It couldn't be further from where the trend is going around industrial and logistics assets. You can see how high the clearance is. You want in industrial property high clearance, meaning that it's useful for more and more tenants. You've got that flexibility. Again, it's a new asset, low capital expenditure. It's a huge facility. And importantly, it's only 2 minutes off the M7 and it's 5 minutes away from the M5. What people don't realise with industrial property is that, yes, rent is important. Rent's always important to tenants. But the kilometre cost to move goods is much more important for a group like Main Freight, who are effectively a distribution business. One of our distribution team members, whenever he's around the country, always tells me, I saw another Main Freight truck. And once you see these kind of tenants in the portfolio, you do notice them all around. So you can see here, very different proposition industrial now to what industrial looked like 20 years ago. And finally, We have created a diversified fund. We had some feedback from investors that they didn't know whether they wanted office or industrial. So what we've done here, whilst it's diversified, it focuses still on a unifying theme around consumer staples. What are consumer staples? Well, put simply, they're goods that people tend to buy regardless of their position. Fuel, medical, food, these sort of things. And again, it's the smallest portfolio we have. It's the most recent product. And what you'll see over time is that that fund will continue to grow and diversify, and it offers investors monthly distribution. So that brings me to the end. I've put this up. This is the direct team. Many of them are standing at the back of the room. I do encourage you, if you have any questions, please do ask them. They're very helpful. They're very knowledgeable. The team's been together for a long period of time. And I'd also encourage you, the listed fund managers will be down here towards the front of the room. If you have questions, they are available. Please do go up and ask. If there's something that's burning desire, just ask them. They're very happy to help. And for myself, on behalf of all of Charter Hall, I would like to thank you all for taking the time out of your busy schedules, for being with us today. I hope you've been able to learn something. As I said, this is meant to be an educational piece, understanding the markets, how Charter Hall does things. So with that, thank you very much and have a nice day.